In this video, we are going to talk about portfolio performance measures. We are going to cover these formulas here: the Sharpe ratio, trainer, Jensen alpha, information ratio, and the M2 measure. Sharpe ratio is a very, very popular ratio out there that measures efficiency. In there saying if you have the return of a portfolio, we take away the risk-free rate. And the idea of doing that is because while you may have a return on the portfolio, you can't really count the risk-free portion because you could have gotten that anyways. That's something you get free of risk. So the portfolio is really what matters, how much more than the risk-free rate is it giving you. And then that's divided by the standard deviation or the risk of the portfolio in order to get a good grasp of how much are you getting above the risk-free rate, considering the risk you're taking. So because we like returns more than we like risk, we like to have low risk and high returns. The higher the Sharpe ratio, the better. The trainer measure does something very similar, but instead of dividing by the standard deviation, divides by the beta. So it's more comparing to the market portfolio specifically, and it gives you some other information. Now, as similar as they are, and also the trainer measure, the higher the better, sometimes they both coincide, and if it's giving you a higher number than the market, sometimes they don't. We'll discuss that a little further. Jensen alpha is very similar to an example we did about the abnormal returns in a different video. But all these here, we're calculating Jensen alpha. Let's talk about this right-hand side piece first. This piece in here inside the brackets, that's CAPM. You have risk-free rate plus the beta of the portfolio multiplied by the market premium. The market premium being the return of the market minus the risk-free return. So this piece is just CAPM. And what we're doing is we're taking the expected return or the average return of the portfolio minus the CAPM portion. If it's positive, your alpha is positive, and it's similar to having an abnormal return when you do the expected returns compared to required returns. Information ratio. I strongly suggest you read this paragraph, also found in the textbook, but it's what we call a tracking error. And it gives you some information regarding the alpha of the portfolio. In this case, Jensen alpha. We're literally talking about Jensen's alpha divided by the tracking error that you see here. And it gives you a piece of information there. And yes, if the number is, the higher the number, the better. So we'll discuss these now in calculation. So let's go ahead and zoom in a little bit. So we have a situation where the portfolio has an average return of 35%. The market is returning 28% during this period. The beta of the market is always 1, as you should know by now. This portfolio has a beta of 1.2. Now, before I move forward, I calculated CAPM here on the side, just so we can do a quick comparison, that the required return is 32.4%. But the return on this portfolio, it's expected to return 35%. So that already tells you this portfolio is performing a little better than the required. So things should be looking good for it. Okay, so the standard deviation of this portfolio is 42%, and the market is 30%, the standard deviation of the market portfolio. We're going to give it a tracking error. We're just going to go ahead and provide this number now. We're not going to get into the calculations. And because a tracking error is compares it against the market, then the market wouldn't have a tracking error. That's the benchmark. That's the base. The risk-free rate in the scenario is 6%. So it's the same for both. And now we get into these calculations. So the Sharpe ratio, we take the portfolio minus the risk-free, and then whatever we get there, we divide it by the standard deviation. So the Sharpe ratio for this portfolio is 0.69. The Sharpe ratio for the market portfolio is 0.733. Now, when you compare Sharpe ratios, they're telling you that the market is being more efficient than this portfolio. So if you're aiming for efficiency, you should go for the market. If you're aiming for total returns, regardless of efficiency, you go for the portfolio. The Treynor measure, as we discussed, is very similar to the Sharpe ratio, but we use beta instead of the standard deviation. And in this case, it's telling us that the portfolio has a better Treynor measure than the market. As I mentioned earlier, sometimes they give you the same decision. Sometimes they don't. In this case, Treynor measure is saying that when comparing the returns against the beta, this portfolio is doing better than the market. That also is in accordance or in tune with CAPM and this number. If the portfolio is returning more than the market after adjusting for the beta, then yes, the Treynor measure will tell you that. And the reason is because they both have beta in their calculations. Now, Jensen alpha, as we mentioned, is just CAPM minus the return of the portfolio minus CAPM, the difference between those two. Earlier, already spoke about that this number was higher than that number, and it would give us positive results down here. So yeah, if I just take 35% minus the CAPM, I get the same 2.6%. And that's what Jensen alpha is. The market, since CAPM gives you the return of the market as with a beta of 1, so the market wouldn't have a Jensen alpha. It would always meet, because that's what we do when we're comparing the market risk-adjusted returns to the market risk-adjusted returns, so you end up with a 0. Jensen alpha for the market should always be 0. Now, the information ratio does not apply to the market, NA, and is because it doesn't have a tracking error, and you cannot divide by 0. However, when we do it here, we do get a 0.14. If you were to compare different portfolios and not the market portfolio, then yes, the higher the information ratio, the better the performance in that case. This M2 measure is another performance measure to compare against the market. This is related to the capital allocation line that was discussed in previous chapters. We had this thing called the complete portfolio, where we combined a risky portfolio or a portfolio with risky assets, and we combined it with a risk-free asset at certain levels, certain percentages, so we can achieve a constant Sharpe ratio. Now, in this case, what we're doing is we're aiming to have the same standard deviation as the market. That's what we're aiming for, the same standard deviation as the market. So what you do is you follow this formula first to decide how much of the portfolio of the risky assets we should have in the combination and how much of the risk-free asset. So it's fairly simple, straightforward, because once you have the standard deviations, all you have to do is divide the standard deviation of the risky portfolio by the standard deviation of the market. Vice versa. The standard deviation of the market divided by the standard deviation of the risky portfolio. I'm going to repeat that correction again. It's the standard deviation of the market divided by the standard deviation of the risky portfolio. And that's going to give you the weight of the risky portfolio in this new combined portfolio. And then you do 1 minus that to get the rest of it in the risk-free asset. So in order to get the standard deviation of this complete portfolio, you multiply the standard deviation of the risky portfolio times the weight of the risky portfolio. And that new portfolio is a combination of risk-free asset and risky portfolio is 30%, which is the same as the market standard deviation. That was the intent. Now the average return is calculated as usual. So we take the weight of the risky portfolio times the return of the risky portfolio plus the weight of the risk-free asset times the return of the risk-free asset. So is your weighted average of returns. So this combination will have an average return of 26.71%. So when we do the difference between the return of this new complete portfolio minus the return of the market, we realize that we have a negative 1.29%. So when you combine this, you're getting an average return that is less than the market, while the standard deviation is the same. So in other words, the market gives you 28% for 30% standard deviation. Here you're getting less than 28% for the same standard deviation. So you have lowered your returns for the same amount of risk. What the message is that maybe doing the complete portfolio in this situation may not be worth it as compared to investing in the market portfolio alone. But these are the measurements that you can do to make different decisions. Which one you follow depends on your strategy and the goal and the intent. Okay, that's it for this video. See you on the next one.